You've saved up some money. You're ready to put it to work. You want that set it and forget it lifestyle where your wealth grows while you sleep. But then you hit a wall. You open your brokerage account and see two giant doors: ETFs and mutual funds. To the untrained eye, they look identical. They both hold a basket of stocks. They both offer diversification, and they both promise to help you retire on a beach. But choosing the wrong one is like picking a car based on the color while ignoring the fact that it has a hole in the gas tank. Over a few years, the difference between these two isn't just a few dollars. It's potentially hundreds of thousands of dollars in taxes, fees, and lost opportunities. Today, we're ending the debate. We're going deep into the mechanics of ETFs and mutual funds. We'll look at the hidden costs, the tax advantages that the wealthy use to stay wealthy, and most importantly, I'm going to give you a definitive framework to decide which one belongs in your portfolio. By the end of this video, you won't just know the difference, you'll know exactly where your next $1,000 should go. Now let's begin with Section 1. The identity crisis. What are they? Let's start with the basics, but I promise there's a twist here most people miss. Mutual funds are the OG, or open-ended fund, collective investing. They've been around since the 1920s. Think of a mutual fund like a private bus. You buy a ticket, your investment, and a professional driver, the fund manager, decides where the bus goes. You can only get on or off the bus once a day after the markets close, at a price called the NAV, net asset value. ETFs, or exchange-traded funds, are the new kids on the block, though they've grown into a $7 trillion giant. If a mutual fund is a private bus, an ETF is a public subway system. It's constantly moving. You can jump on or off at 10:30 a.m., 1:15 p.m., or 3:59 p.m. It trades on an exchange just like a stock. Now, here is the key you need to understand: management style. Most mutual funds are actively managed. This means a team of highly paid analysts is trying to beat the market. They are picking stocks they think will win. Most ETFs are passively managed. They aren't trying to be smart. They are just trying to mimic an index like the S&P 500. The math of reality. Data consistently shows that over a 15-year period, more than 90% of active managers fail to beat the S&P 500. You are paying someone a premium to underperform. Does that sound like a good deal to you? Section 2. The fee assassin, expense ratios. Let's talk about the silent killer of wealth: fees. In the world of investing, you get what you don't pay for. Mutual funds often come with sales loads. Imagine walking into a store, buying a $100 shirt, and the cashier says, "That'll be $105 because I had to fold it for you." That's a front-end load. Even without loads, mutual funds usually have higher expense ratios. A typical active mutual fund might charge 1.0% or higher. An S&P 500 ETF. You can find those for 0.03%. You might think, it's just 1%, who cares? Let's run the numbers. If you invest $100,000 with a 7% return over 10 years, at a 0.03% fee, you end up with roughly $250,000. At a 1.00% fee, you end up with roughly $191,000. That 1% difference costs you $60,000. You didn't just lose money, you lost the compounding on that money. That's a house. That's a decade of early retirement. This is why the structure of the fund matters more than the name on the letterhead. Hang on till the end, because the following paragraphs contain game-changing information that will benefit you in your investing journey. Now let's look at Section 3. The Taxman's Secret. This is the part where most investors get blindsided. It's called tax efficiency. Mutual funds have a major structural flaw. When people want to leave a mutual fund, the manager often has to sell stocks inside the fund to give those people their cash. If those stocks have gone up in value, it creates a capital gain. Here's the kicker. Even if you didn't sell a single share of the fund, the IRS makes the fund pass those capital gains taxes on to you. You can literally lose money in a mutual fund in a bad year and still get a tax bill. On the other hand, ETFs are different. They use a heartbeat trade, or in-kind, creation and redemption process. Without getting too technical, it means they rarely have to sell stocks to meet redemptions. They just swap shares with big institutions. Result: ETFs rarely trigger capital gains until you decide to sell your shares. You are in control of the tax bill, not some panicked investor in Ohio who decided to sell his shares at the wrong time. Section 4. When is a mutual fund actually better? I've been hitting mutual funds pretty hard, but they aren't all bad. In fact, for some of you watching right now, a mutual fund might actually be the superior choice. Wait, what? It comes down to behavioral psychology. 1. Fractional shares and automation. Many older brokerage platforms make it easier to automate mutual fund investments. You can set it to pull $500 from your bank account every Friday and buy exactly $500 worth of a fund. With ETFs, unless your broker allows fractional shares, you might have to buy whole units, leaving lazy cash sitting in your account. 2. The slowdown effect. Because ETFs trade like stocks, it's tempting to check the price every 5 minutes. It's tempting to day trade your retirement. Mutual funds only price once a day. This friction can actually be a feature that prevents you from making emotional, impulsive decisions during a market crash. If you are the type of person who can't stop fiddling with your portfolio, the clunkiness of a mutual fund might save you from yourself. Now let's look at the verdict and the bridge. So, what's the final verdict for the long-term investor? If you want the lowest fees, the best tax efficiency, and the most flexibility, the ETF is the undisputed king. For 90% of investors, a simple portfolio of broad market ETFs is the most efficient path to wealth ever created. But remember, building the pile of money is only phase 1. Once you have the wealth, the question changes. You no longer care about growth as much as you care about cash flow. You don't want to just look at a big number on a screen. You want that money to hit your bank account every month so you can actually live your life. You want to move from total return to dividend income. And that brings us to a very specific, very powerful strategy. Imagine a world where you don't have to sell your stocks to pay your bills. Imagine a portfolio that acts like a private ATM, depositing $5,000 into your account every single month, regardless of what the market is doing today. If you're ready to graduate from just holding assets to making them pay your rent, you need to see our next deep dive. Live off dividends, the dividend income strategy that pays you $5,000 every month. Click the video on the screen right now, and I'll show you the exact math and the specific tickers to make that $5,000 monthly check a reality. I'll see you over there. Like this video and subscribe to the channel for weekly investing videos.